Right now, there are retirees around Australia sitting on $800,000 in super who are quietly selling an investment property or clearing out a share portfolio because they are convinced a new tax is about to hit them. It is not. Their balance is nowhere near the number that actually switches anything on. You have probably seen the headlines about the end of the capital gains discount and a 30% tax on super balances. If you are one of the people rushing to sell assets before the 1st of July 2027, to dodge a change that does not even apply to you, you could be creating a capital gains bill of $60,000 today to avoid a future cost of exactly zero. I have watched people who did everything right for 30 years make their single biggest financial mistake in one afternoon, purely out of fear. This is not about being careless with money. Most of the people I am talking about have been disciplined savers for decades. The confusion is coming from the headlines themselves, because two completely different tax changes are being reported as one single threat. Call it the phantom tax trap. People are cutting their own retirement income by as much as 15% a year, not because the government took it from them, but because they miscalculated who these rules were actually built for. Over the next few minutes, I will walk you through the exact threshold test that shows most of you have nothing to worry about here, and the one specific group that does have something to watch and is currently doing nothing about it. If you are between 55 and 65 and trying to work out whether the government just moved your retirement goalposts, stay with me. We track these changes so you do not have to guess at them. Here is the number that actually matters. The new super tax everyone calls Division 296 only touches people with a total super balance above $3 million. If your balance sits at $2,900,000, your tax rate on what your super earns stays exactly where it has always been, 15% while you are still building it up, and 0 once you have moved into a pension. That gap between $2,990,000 and $3 million is not a rounding error. It is the entire line the government drew. Since the 1st of July 2026, an extra 15% tax applies, but only to the earnings your fund makes on the slice of your balance sitting above $3 million. Not your whole balance, not your first $3 million, just the growth on top of it, and only once that growth is actually banked, not simply while it sits there on paper. That last part matters because the original proposal would have taxed you on paper gains you had not even sold yet. It was changed before it became law. Here is where people trip themselves up. Owning your home outright and having a healthy super balance feels like being wealthy. It is a fair feeling, but feeling wealthy and sitting above a $3 million total super balance are two completely different things, and most people who panic about this tax are nowhere close to the second one. I have sat across from people who own their home, have $400,000 in super, and are still convinced this law is coming for them. It is not. Take Mary. She has $1,200,000 in super. She hears the words 30% tax on the news, assumes it means her, and pulls $300,000 out into a regular bank account. Inside super, in pension phase, that $300,000 earning 5% a year makes $15,000, completely tax-free. Outside super, in her own name, that same $15,000 gets taxed at roughly 30%. She just volunteered to hand over $4,500 a year in tax she never owed in the first place. Treasury's own figures put the number of people actually affected by this tax at under 1% of taxpayers, somewhere around half of 1%. That is the group this was built for. And if your balance sits comfortably under $3 million, the headlines are not describing your retirement. But what if you do hold serious money outside super, in shares or an investment property? That is where a different kind of self-inflicted damage is showing up, tied to a change coming in 2027. People are selling investments right now to lock in the current 50% capital gains discount before it gets replaced. The instinct makes sense. The execution is where it goes wrong. Here is the part most people miss. Any asset you already hold is grandfathered. The gain you have built up until the 30th of June, 2027, still gets taxed under the current rules with the 50% discount intact. You do not lose what you have already made. From the 1st of July 2027, the 50% discount is being replaced with cost-based indexation and a 30% minimum tax on the real gain once inflation is stripped out for assets held more than 12 months. That new treatment only applies to the growth that happens from that date forward, and it applies whether the asset sits in your own name, in a trust, or in a partnership. I used to tell people to simplify their portfolios early and sell down ahead of any legislative risk. I was wrong to be that blunt about it. With indexation replacing the discount, holding a good asset often beats selling it and paying stamp duty, brokerage, and an immediate tax bill just to avoid a rule that has not even started yet. Run the numbers. Say you bought an investment property in 2010 for $400,000 and it is worth $800,000 today. Sell now and you pay capital gains tax on that $400,000 gain with the 50% discount still applying. Hold it through to 2030. And the discount still applies to every dollar of growth that happened before the middle of 2027. Only the growth from that point on gets taxed under the new indexation and minimum tax rules. And indexation means the tax office measures your real gain, not the part that is just inflation pushing the price up. Selling early to dodge a rule that has not started yet does not protect you. It just stops your money compounding and hands the tax office a check sooner than you needed to write one. One detail worth knowing if you are living mostly on the age pension or another income support payment. The new 30% minimum tax is not designed to catch you. It is built to apply to people whose gains would otherwise sit well below that rate, which is not the position most part pensioners with modest share portfolios are in. If your income already includes means-tested support, this particular change was written to leave you alone. That is the trade-off buried in all of this. Selling early feels like safety, but it converts a future, uncertain tax bill into a real, certain one today, and gives up years of compounding to do it. On top of paying agent fees or brokerage you did not need to pay this year at all. There is one scenario where selling actually is the right move, and it shows up if the market drops hard right after these new rules switch on. Picture a market downturn in late 2027, not long after the new capital gains rules start. Someone who has spent the year anxious about the changes sees their portfolio drop and sells everything in a panic, convinced they have missed their chance to do anything useful with the loss. They have not. Capital losses in Australia can be carried forward indefinitely. There is no use by date on them. You can hold a loss for 10 years and still use it the day you finally have a gain to offset on a share sale, an investment property, or almost any other asset that attracts capital gains tax. Here is the part that actually works in your favor if the timing is bad. A capital loss made after the 2027 changes offsets a gain that would otherwise have faced the 30% minimum tax, dollar for dollar. Under the old 50% discount system, that same loss was offsetting a smaller effective tax bill. The mechanics changed, but the safety net around losses did not disappear. It arguably got a little more useful. Think of it as two paths through the same downturn. One person sells at the bottom, locks in the loss as a real cash outcome, and loses the tax shield along with their nerve. The other person holds, lets the loss sit on the books as a carried forward asset, and uses it later against a future gain, on their own timeline instead of the market's. The practical version of this looks like keeping a simple record. Note the date you sold, what you paid originally, and what you sold it for. Your tax return carries that loss forward automatically each year until you actually have a gain to use it against. Nobody needs to remember it perfectly. The paperwork does the remembering for you as long as it gets lodged. None of this means you should never sell during a downturn. It means the decision should be based on what you actually need the money for, day to day, rather than a fear that the tax rules have left you with no options. They have not. I have seen people treat a market drop as proof that every plan they made was wrong, when the actual mechanics of the tax system were quietly working in their favor the entire time. The fear moved faster than the facts did, which is usually how people end up locking in a real loss to avoid an imaginary one. If your instinct after all this is to move money into a family trust to get away from these changes altogether, there is a different trap waiting there, and it involves a rule most people have not heard about yet. From the 1st of July, 2028, trustees of discretionary family trusts will pay a 30% minimum tax on the trust's taxable income, with the individuals who receive the money getting a credit for what the trustee already paid. It is not a ban on trusts. It closes a gap that has existed for a long time where trust income could be split around a family to land in lower tax brackets than the same money would face if it stayed with one person. This is not new territory for Australian tax policy. Back in the 1980s, the government spent years closing down schemes built around company structures being stripped of assets and abandoned once the tax bill came due. People called it the bottom of the harbour era. The government was not banning companies then, and it is not banning trusts now. It is closing a specific gap, the same way it always eventually does once a structure gets used for something beyond what it was built for. Here is a belief I hear constantly, and it is wrong. People assume that restructuring a family trust automatically triggers a large stamp duty bill, so they either freeze and do nothing, or panic and pay for advice they cannot really afford. In most states, stamp duty applies to dutiable property, which mainly means real estate. Transferring a share portfolio or cash between trust structures generally does not attract it in the same way, though the exact rules do shift slightly from state to state, which is exactly why this is worth one proper conversation rather than a guess based on a headline. I have seen a family pay around $67,000 in stamp duty they did not need to pay because they restructured a property-heavy trust without checking which assets actually triggered the duty and which ones did not. A short conversation with the right advisor before moving anything would have saved them most of that. The mistake was not the restructure itself. It was doing it in a hurry, based on fear of a headline rather than a plan. Nobody watching this needs to become a trust law expert by next week. What matters is knowing that the coming change targets income splitting inside trusts, not the existence of the trust, and that moving assets around inside one is not automatically a stamp duty event just because it involves the word trust. So how do you actually build something that holds up, no matter who is running the country in 3 years? Step 1 is the $3 million audit. Log into your MyGov account, find your total super balance, and look at the actual figure, not the number you assume it probably is. If you are sitting comfortably under $3 million, with room to spare, the Division 296 headlines are simply not about you. Stop reading them as a threat, and stop letting them steer decisions about assets that were never in scope. Step 2 is about timing, not tricks. If you are holding shares or property with a large unrealized gain, talk to a professional about the pace at which you realize those gains between now and the middle of 2027, rather than making a single rush decision because of a headline. Grandfathering protects what you have already built. There is no reason to force a sale this year that you were not already planning to make, and no reason to let a deadline that mostly affects future growth dictate what you do with money you need to live on today. Step 3 is using the caps you are actually entitled to. The concessional contributions cap for the 2026 to 2027 financial year is $32,500. Moving that amount from a bank account taxed at around 30% into super, taxed at 15%, is an immediate saving of roughly $4,875 before your money has even grown a single dollar. If you have not used your full cap in earlier years and your balance is under $500,000, you may be able to carry some of that unused room forward too, which is worth checking rather than assuming it has expired. None of these three steps require you to predict an election or guess at future legislation. They require you to look at your own numbers instead of the headline and to act on a timeline, not a panic. Which raises a fair question. Why is it so hard to just sit still when the news is shouting at you? There is a name for what is happening here: loss aversion. We feel the sting of a new tax roughly twice as sharply as we feel the relief of an old one staying the same. That is not a character flaw. It is how most people are wired, and it gets stronger, not weaker. Once your income stops coming from a regular paycheck and starts coming from a balance you have to make last. It is completely normal to feel like the system is coming after money you spent 40 years earning. That feeling deserves to be taken seriously before anyone tries to talk you out of it with numbers. A headline about a new tax lands differently at 58 than it does at 32, because there is far less runway left to earn your way back from a mistake. Here is a small shift that helps. Instead of fixating on the tax rate itself, look at your net spendable income, the actual amount landing in your account each fortnight to cover the groceries, the electricity bill, and the car registration. In most of the cases we have walked through today, these changes reduce what gets left behind for the kids far more than they touch what you have to live on day to day. That is a real cost, and it is fair to care about it, but it is a different cost to the one the headlines imply. I do not know your family's situation, and I cannot tell you what Parliament will look like in 2028. What I do know is that the math in front of you does not have feelings about it either way, so it is worth letting the math speak before the headline does. Do not sell an asset to avoid a tax you were never going to owe. Check your real total super balance against the $3 million line, not the number you have been assuming in the back of your mind. Remember that grandfathering protects the gains you have already made, and that a family trust is not a trap in itself, just a structure worth understanding properly. Use your full $32,500 contribution cap while it is available to you. If this cleared up some of the fog, subscribe to Aussie Retirement with Bob. We are here so you retire with confidence instead of guesswork, and we will keep tracking these changes as they actually land, not just as they get announced. The system is genuinely complicated. Your response to it does not have to be. Check the numbers. Talk to someone qualified before you make an irreversible move, and stay the course.